A catastrophe bond is a really fascinating instrument. So most people don't know this, or I didn't until I started working in the insurance industry a long time ago. Insurance companies also need insurance, right? So they don't have enough capital themselves to kind of like self-insure if there's a disaster because they're counting on diversification of risks, right? So an insurance company that only insures properties in Western Europe is then susceptible to a disaster if they're like big wildfires or the floods or whatever might be an earthquake. It's not a big earthquake zone. Here we have typhoons, etc. So the insurance industry started issuing bonds, and these bonds would be, generally in the shorter duration, 3 to 5 years, and the payment on the bond is conditional on what happens from an insurance perspective during the life of the bond. So if you issue a bond for, let's say, you're going to cover, um, you know, uh, typhoon risk in the Philippines and Indonesia. So you would define certain parameters of typhoons that would act as a trigger. And so if a storm that was severe enough or matched the characteristics of the trigger that you developed when you issued the bond, you said, this is my trigger. If there's essentially a covered event, then the insurance company will take some of the principal amount from that bond and use it to cover its losses. So as an investor in catastrophe bonds, you're basically taking a view on weather risk. It could be, typhoons, it could be of volcanic activity, it can be earthquakes, can be fires, can be floods. And the neat thing is that if you're thinking about your portfolio, most of what we start with in stocks and bonds is basically highly correlated to what happens to the market overall, even if you're buying an
Mm.
individual stock, right? You're taking a lot of stock market risk, but the weather is not correlated to the stock market, right? So it diversifies your risk. The problem is that you also have to be able to say, well, how well do I understand weather risk?
Mm.
And most of us don't. So um, depending that one in particular, as individuals, we really wouldn't go out and buy a catastrophe bond, but we'd look for funds. They tend to be available more through bank networks and private banks, but there are some firms that make these catastrophe bonds available in a mutual fund form, and I find them fascinating for their lack of correlation. Now, the last thing I'll say there is now we're in this climate change world, and actually the results from cat bonds over the past 5 years have been really materially worse than they had been for the 15 years before that. So we've got to ask ourselves the question, like, is the weather changing so much that in fact the industry has not figured out how to price that in a way that we should feel comfortable investing in these kinds of instruments?